Good morning, everybody, partners and friends, and thank you so much for joining our 2018 Mayar Capital Annual Partners Meeting. It's wonderful to see so many of you here this morning, and special thanks to those of you that have travelled a long way to come here. Aziz will begin the proceedings in just a moment with his opening remarks, followed by a performance and portfolio overview. And after this, we'll hear from our special guest speaker, Mr. Dimitris Valatas. Aziz will then lead a question and answer session and looks forward to answering all your questions. And we expect to be finished by around 11:30 a.m. The event is being filmed today, as you have probably noticed, and this is for use on our website and social media channels. If anyone doesn't want to be filmed, if you could just grab my attention during Aziz's opening remarks. And should you need any assistance at any point, if you just grab either myself or Philip, who's sitting just here, we'll be pleased to help you. That just covers everything from me, I believe. So without further delay, let me hand you over to our founder and managing partner, Aziz.
Thank you, Sophie. Good morning. Thank you all for coming. I really appreciate you joining us this morning, especially people who have traveled from Saudi to the meeting. I'd like to first start by thanking Sophie, who put the whole event together. I really didn't do anything. This is the second time she does it, and she just keeps upping the ante, and we'll be in Wembley Stadium very soon, I hope. And I'd, of course, like to thank everybody who works with us every day, the team, all our partners who help us make things actually happen, our board of directors, and all of our investors who we feel very fortunate to be trusted with their capital and take this responsibility very seriously. I know I have the best job in the world. I wake up every morning and I walk to work. And on the way there, I think about how amazing of a deal I got myself into. I'm doing what I like, and I'm doing it with people who are really enjoyable to work with. They make life amazing, and I never feel like I'm working. And that is something that I'm very grateful for. And I'm very lucky to have achieved it in my life. I'm going to go through some opening remarks. We'll go quickly through some of the performance for the fiscal year, some updates of what happened since, and then we'll actually get someone who has something valuable to say to come up here, and then we'll answer some questions. All right. Like we always do, we like to talk about our three pillars, our partnership principles, our strategy, and the investment process. And I think people talk about being special and being differentiated and being different. And while my mother has always told me that I'm special, life has taught me that I may not be really that special. So I needed to find ways to make myself different. And the first thing we did that I think is the core to everything that we do is the document that we call our partnership principles. Shortly, we talk about it as straight talk, in it together, only long-term, and being risk-averse. Our strategy is our second pillar, where we want to expose ourselves to great businesses by buying the securities of wonderful companies and not overpaying for them. And a process that is built on overcoming our fallacies as human beings, falling to a victim to behavioral biases like everybody else in the world. And so we've built a process that tries and I think achieves a framework that helps us overcome these fallacies, or at least when we do fall victim to them, this checklist-based process helps us avoid repeating the same mistakes again. So, the year in question, so for the fiscal year that just ended, on a pre-incentive fees basis, the fund was up 13.2% versus an 11.09% increase for the MSCI World Index. And that takes our performance since inception to 109% versus 80.7% for the MSCI. We'll talk a little bit about asset allocation, but we did achieve this year's result while carrying significant amounts of cash and being conservative for reasons that I think we're going to talk about later. I'm sure Dimitris has a lot to say on that. Our top 10 positions at year-end, the biggest was Essential, which is a UK-based media company. Its most prominent product is WGSN, which essentially is the Bloomberg of the fashion, design, and trend industries. Second biggest position, and you'll see some changes regarding that, was Microsoft and Alphabet, and then Nordstrom, Discovery, and the rest of the list. Geographically, we continue to have a broadly diversified portfolio on our preferred measure, which is the one on the left, where we look at portfolio exposure by the revenues of the underlying companies that we own, which is, in our opinion, the most relevant factor because that captures the economic risk that we're actually exposing ourselves to, and that remains broadly diversified, fairly similar to global GDP. We talked last year about the changes in where we invest in terms of listing, having significantly decreased our exposure to US companies. That continued to be the case in 2018, especially the past 2 months, which I'll talk about in a couple of minutes. And again, we continue to have a broadly diversified portfolio in terms of industry. This is what the geographic exposure looks over time. I think if you look here, this is what we were talking about last year, having gone from, this is by revenue. This one, having gone from more than 80% down to 45% earlier in the year. And again, now let's look at the fundamentals. We've been asked this question before. Why does your PE ratio seem relatively high when you say that you're a value investor? And if you look at the blue line is our underlying portfolio's PE ratio, the gray line is the MSCI World, and you see that it's been fairly similar over time. However, that's not how we define value. And this is the more relevant measure in our opinion. This is the free cash flow yield of the underlying portfolio. So while the PE ratio is similar, you can see the free cash flow yield, which is the inverse of a multiple to cash, remains substantially above. There's an issue obviously with the scale there, but remains substantially above. And while we're buying businesses that generate a lot more cash, we also own businesses, and this is return and capital, that have significantly higher returns on capital, which means that we have businesses that are of better quality, and they are able to achieve that and generate the higher free cash flow while also maintaining significantly lower leverage than the average company. So basically what we're trying to do is we're trying to pay average or slightly better than average prices to buy significantly better than average businesses. That's always been our definition of value. This is what happened to the portfolio during the year. The main moves in terms of new positions are buying Merlin, which we did earlier this year, Kyosho Railway in Japan, L'Occitane, which is a French company, but it's listed in Hong Kong for funny reasons. We also bought a chemical distributor in Germany called Brenntag, which we can talk about a little bit later. And we finally got into high tech and bought Procter & Gamble a couple of months ago. Out is Scripps Networks, which got merged with one of our other companies, Discovery. We actually sold the shares prior to the merger because we believed that the spread between the shares that have been tendered and the price of the merger did not justify the risk. So we didn't want to play a merger arbitrage game that we that is a different game than what we like to do. So we sold the shares and bought more Discovery. We also sold Nestle earlier in the fiscal year because we believe that there are better opportunities in the sector and in other places in the world. I talked in Q2 about why we sold Expeditors. It's basically the headline that Dimitri's stock is going to be about. And we also reduced and then eventually sold completely our position in Swatch while keeping Richemont purely on valuation, having done a mediocre return on that one specifically. Since inception, we've managed to catch up and make a decent IRR by buying more when the stock declined 2 years ago. We bought more Nordstrom during the fiscal year, and more recently it did extremely well. We can talk about that a bit later. We also bought more Evertec, which is the Puerto Rican payment company that we owned. Unfortunately, we still cannot forecast hurricanes. We especially cannot forecast how governments that don't function deal with hurricanes. But luckily, when you buy at a good price and you buy a good company, you still do well. And that's what happened with Evertec. We bought more Discovery, like I said earlier, continued to buy. And again, it did well for us this year. And we also bought Johnson & Johnson more recently. We sold Alphabet. I'm going to talk about this a little bit later and why we sold more. And we also sold Lindy, which also is going to merge / get acquired by the US competitor Praxair. For the same reason we sold Scripps, it got into essentially a merger arbitrage play, which is not what we do. Since the beginning of this fiscal year, so since July 1st, portfolio is up 5.4% versus 4.7% for the MSCI. That brings the cumulative return since inception to 120.7% compared to 89.3% for the MSCI. The returns here, of course, are for the initial Class A series. Top positions changed a lot in the past 2 months, which is not typical that we have things change, but we can discuss a bit later. Our biggest position is now Nordstrom, mostly because of gains. But then we sold a big chunk of our tech holdings. And so the second largest is Henkel, which we bought a little bit more of. Discovery, purely on gains. And I talked earlier about buying P&G. Again, portfolio activity the past 2 months. The biggest moves are really continuing to sell down our Alphabet shares. We continue to think that the business is fabulous, but we still think the valuation is relatively fair. However, we continue to think that the risks on the regulatory front especially are going to increase. And then again, tweets yesterday and the day before continue to confirm that thesis. And so we've essentially done it for risk management purposes. We also sold some Microsoft on valuation very recently. For the same reason, we also sold some Visa and MasterCard and bought more Henkel. And here are the two big changes in terms of portfolio exposure since the beginning of the fiscal year. IT, which is, again, selling Alphabet, Microsoft, Visa, and MasterCard, goes from 32% to 24% of the portfolio, while cash goes back up to 16. We started the year at 16. At the time of our last annual meeting, we were up to 18% cash. We got volatility back earlier in calendar 2018 and went to very low single-digit cash as we were able to deploy money into volatile markets, which helped us a lot during the fiscal year. And now that things have gone back up in terms of valuation and we continue to sell, I think we got a question on how we think about cash that someone sent, so we'll actually discuss this in more detail and why cash changes in our portfolio. And this is the other result of that move, exposure by listing to North America going from 54% to 49%, and then again cash going from 10 to 60. This concludes my prepared remarks. I will hand it over to Sophie now.
Thank you, Aziz. So it's time to hear now from our guest speaker for the day, our friend and European Director at Greenmantle, a macroeconomic and geopolitical advisory firm, Mr. Dimitris Valetas. Dimitris holds an AB in economics from Harvard University and a master's in modern languages from the University of Oxford. He specialises in European macro and energy economics. Prior to joining Greenmantle, he worked as an economist for FTI Consulting, and he is fluent in German, Greek, and French. Dimitris, over to you.
Thank you very much. All right. Morning, everyone. Thanks very much, Aziz and Sophie, and the team for inviting me to give you a few thoughts on the geopolitical developments as we view them at Greenmantle. Bit of background, Greenmantle is a geopolitical and macroeconomic advisory firm founded by historian Neil Ferguson in 2011. For a long time, I handled mainly the macroeconomic side of this, but the geopolitical side of the business, there was no one in the world, I think, happier when Donald Trump got elected than geopolitical advisory services. In a sense, we knew from the very first day that geopolitics is back. And this is what today's talk is going to be about. It's going to be about what the world looks like now that geopolitics is back, now that Donald Trump and a much more assertive United States has brought back the concept of geopolitics that had been dead essentially since the end of the Cold War. This is the Trump's latest campaign slogan when he goes out to West Virginia and campaigns in front of the American people. He never stopped doing that, by the way. Promises made, promises kept. And it's a statement we actually agree with, but I'll go into length about that in a second. First, a bit of a historical perspective on the United States. This post-1991, essentially, period here of near zero tariffs is actually an exception for the United States. Historically, the US has been a protectionist country. It hasn't been a free trade country. It advocated free trade during the Cold War for ideological and essentially geopolitical reasons. But in its history, and this is the average tariff rate on all imports for the United States going back to 1820, which is the earliest we could find data for, has not been a proponent of free trade. It's been a protectionist country. When Donald Trump entered office, and he promised that trade wars are good, I think, and easy to win, he launched an all-out attack on global trade. And this was what we call the first phase of the trade war, which started earlier this year in March, and we think may have ended around July. These are all the countries that have retaliated against the United States with tariffs of their own. Basically, anyone strong enough to do so did so. Notable absences here are Australia, Brazil, Argentina. Basically, when Donald Trump said either you sign up to voluntary quotas, which are illegal under WTO standards, or we impose tariffs, they said, okay, we'll do the illegal thing, not a problem. The European Union, China and Japan had different views on that, and as did Canada. So that was phase one of the trade war. And actually, we do not think really aligned with what even the Trumpians and the protectionists thought was America's best strategy. And we saw a shift in that in July and coming up to the NAFTA deal last week. This is European Commission President Jean-Claude Juncker. He went to Washington, D.C. and somehow managed to negotiate a trade truce with the United States. So put an end to the tit-for-tat retaliatory tariffs, at least a temporary end, that would have hit US automobile producers, which was what the Europeans feared the most. Now, the impact on Europe is undoubtedly good out of that. And we also think the impact on America, from Donald Trump's perspective, is good, because it allows the United States to concentrate the trade war, to concentrate its new antagonistic trade policy on one country and one country alone, having sorted the EU for the time being, and NAFTA, Trump has concentrated on China. And we expect a series more tariffs to keep coming up until the midterms this year. Now, if you are a believer in free trade, like I am, a liberal, like I'm sure many of the people in this room are, and you read Donald Trump's tweet that trade wars are good and easy to win, you might have, said, whoa, what's he talking about? Well, the stock market disagrees with you, unfortunately. This is the comparative returns in the Chinese and US stock markets since the beginning of the year. As I'm sure you all know, the S&P 500 is at all-time highs. The equivalent Chinese Shanghai Stock Exchange is about 25% down. So Donald Trump is right, at least as far as the market is concerned. US economy, US listed companies are winning the trade war. And China is losing the trade war big time. Not just in terms of returns, but there is a financial crisis, that has been brewing for a while. China is a very levered economy. The government has to engage pretty much every fiscal and monetary instrument they have at their disposal to prevent a collapse in growth. That would obviously have consequences beyond China. We are seeing some very worrying signs of a slowdown in the Chinese economy, but we are also hearing very strong rumors of a strong fiscal counteraction to that. And we do think China still has the capacity to engage monetary and fiscal stimulus in the way that the West does not at the moment. Thankfully, the West doesn't have to do much about it because the US economy is taking the trade war in stride. If anything, US companies are outperforming the European and Asian peers, and the US consumer remains very strong. It turns out, if you're the technological leader in the world, you can do import substitution in a way that developing economies cannot. A lot of people, a lot of our clients are worried about what flatness in the curve means for the US economy. We've actually looked at the historical background of curve flatness and compared it with recessions, and we do not find a very strong correlation of curve flatness with a coming recession. It can be a predictor, but it doesn't have to be. And we don't think, at this moment, we don't see the concomitant signs that would push us to think the trade war is having as big an impact in the United States that it could cause a recession. We also do not align with those voices, primarily in Europe, who say, you know what, we can just ride this guy out, let's just stick to the rules, the US is going to come back into the fold by 2020. And the reason we disagree with that is because the American people disagree with that. If you think that the Democrats are going to win the midterms, they're going to win the House in November, and that's going to cause a shift in United States policy toward being pro-trade, you'd be mistaken. The Democrats are actually as anti-NAFTA, as anti-TPP, and as anti-global trade deals as the Republicans, if not more. So, in a sense, we think both the world and investors need to prepare for a world in which the free trade default is no longer the default. So that is the good part of the new world, in a sense that America is undoubtedly, until now, the winner of the trade war it started. Europe is definitely not a winner, but it's not doing so badly either. This is the growth composition of the Eurozone. We see the weight of growth has shifted away from net exports, which is pretty much all it did during the Germanification years, so 2012 to 2014, and is now very broadly balanced. So we think Europe is, of course, vulnerable to disruption in global trade flows, but not as vulnerable as it would have been 5 years ago. So people who are worrying very much about the Eurozone, there are good reasons to worry about it, but the trade war is not as dangerous as it looks at first. The reason for that, of course, is European Central Bank policy. The Eurozone banks are lending again. They've been pushed by unprecedented QE to do that. And that has helped and is continuing to help the domestic economy. So America is the good, Europe is the bad. Let's turn to the ugly. For emerging markets, the picture is looking much worse. The guy on the left, his currency lost about 20% yesterday. The guy on the right did much better on 7% or something. They're both down around 40% for the year. There's a real shock going through emerging markets, and the most vulnerable ones are being hit. The main reason for that, we think, is not the trade war. It's actually central bank balance sheet expansion is behind us. And if you believe in QE and monetary policy as being symmetric, in the sense that as the Fed and the ECB crowd out domestic investors from safe assets into riskier and riskier assets, eventually those flows will find themselves in emerging markets, emerging market equities, emerging market debt, the riskiest assets in the world. When that process reverses, and we are now in the, we see the start of reversal, the Fed is actually selling bonds back into the market, the ECB will stop buying bonds at the end of the year, global balance sheet expansion is reversing, and we think the fortunes of emerging markets are the first ones to suffer. Not all emerging markets. Again, this is the slide I was talking about on Turkey's lira, Argentine peso, but we also put the Mexican peso up top to see, there's very much a sense of differentiation. It's not like the 90s where every single emerging market is being hit. Notably in Asia, emerging markets have very strong balance sheets, and the dynamics look strong. It doesn't look like we're about to be flooded with emerging market crises like we did during the tequila crisis, early 90s, or the Asian financial crisis in the late 90s. Historically, the thing that emerging markets should worry the most about is dollar strength. If the Fed proceeds with tightening at a much faster pace than every other global central bank, and this causes a significant appreciation in the dollar, we find that in the historical record that has the highest correlation with emerging market crises. The second highest correlation is commodity price drops, over 5%. Obviously, a lot of emerging markets are commodity exporters. The combination of the two, which unfortunately tends to happen together, would be the worst. That said, there are still opportunities in oversold emerging markets, and investors who can move in quickly enough, or at least find value quickly enough, can find opportunities in countries like Mexico, for example, where political news, NAFTA renegotiation drove valuations very low. The reality seems to be much more benign. This is the old president and the new president of Mexico, and they seem to be getting along very well. Same can be said for people who invested in Mexican assets during the turmoil of the election and came out on top. And I'll leave you with that. Thank you very much.
Thank you very much, Dimitris. We're now going to go straight into a question and answer session with Aziz.
Thank you, Dimitris. You see why I don't do this stuff? It's really hard. Really appreciate it, you coming here and talking to us. Someone was trying to, I read in the paper, do a Sadiq Khan balloon with the title, "Make London Safe Again, Allah Make America Great Again." So it looks like the lessons learned in the US are transferring over here. And before we know it, maybe Corbyn will be in power. But I think before we get into questions, I wanted to say that the world is changing and it's getting more complicated. But I truly think the world has always been changing and has always been complicated. And I think that we tend to take or put a lot of attention at times when the changes go against what we happen to believe at that moment in time, and then think everything is stable when everything fits with our specific opinion or worldview at another moment in time. But the reality is, if you look back over history, things have never been stable. And the lesson for, at least for me, from observing that is to always think about a longer period of time, to always think about where we could be wrong, but most importantly, to always think where we would be betting without knowing on an outcome. And that's one of the things that I think we internally started to think a lot about the past couple of years. Basically, the decisions and positions and bets that we make without knowing. And often, because of inertia, I think, people stick to one thing and not know that they're exposed indirectly through that to a risk that they didn't know was there or weren't aware of it. And so purely from a risk perspective, I find that we more and more think about these indirect effects. And I think one of the questions that we're going to get soon relates very specifically to indirect effects. Now, I would like to invite Aubrey and Philip to join us up here. We got many questions that have been pre-sent. Really appreciate it that people did that. It helped us think about some of these questions, prepare some slides when needed. And then we'll do one question. Sophie will read some of the questions that people have pre-sent, and then we'll do one from the floor, back and forth until we're out of questions. The plan is I'm going to answer the easy ones, and Philip and Aubrey will answer the hard ones. So please, Aubrey and Philip.
Okay. Ready to start with our first question. So this is actually two related questions. Firstly, what's the outlook on future asset prices as global liquidity is reduced from markets? And how does Aziz and the team view the impact of reduced global liquidity on the portfolio's companies in terms of valuations and earnings power?
Aubrey, you want to take that one?
So I've been reading a book at the moment called Scale by Geoffrey West. And there's a fascinating little bit about Brunel and started talking about turbulent flow. And I realized that that's actually quite similar to the markets. That turbulence that you see in water, when you have momentum of water, okay, I'm not going to explain it very well, but you get movement at orthogonal angles. And there's this mathematician called Reynolds who came up with a way of predicting turbulence. Now, I'm not saying I can use this as a trading strategy, but just the principle actually is quite analogous. That the more viscosity, the less turbulence you get. Yes. And the same applies to liquidity and momentum of markets. Now, so the problem is, when you have reduced liquidity, you are going to get more turbulence in the markets, but this is orthogonal, it is not directional. It could be, that could go up, it could go down, and it's not our job to try and predict that, but it is our job to try and prepare for that, and to have a portfolio which is balanced in a way that will benefit whichever direction that happens.
No further comment. I've been waiting to say that. Actually, I do have one thing that I think is worth mentioning on this. It relates to the second part of the question. So, two people ask essentially the same question, but The second one is slightly different. So I think the first level impact is the impact, like you said, on the market itself, which is the literal question. But I think there are secondary impacts that could still make a difference over a longer period of time. And so if you think about it, so the literal lack of liquidity in the securities themselves is going to cause more volatility, like you said. That's the main and most obvious impact, and the one that's most immediate. However, if we do have a prolonged period where there's reduced volatility, then there could be secondary impacts on the flow of capital into equities, all kinds of equities, whether listed or not. In a sense, investors will price in higher volatility and demand probably a higher return, which means that from a discounted free cash flow point of view, you're now discounting the free cash flow of these underlying companies from now until Judgment Day at least a slightly higher WACC, which means that you do end up with lower stock prices, holding everything else equal, of course. The economists speak. And then if you do have that, then the third effect could be the reverse of a wealth effect, which has been more pronounced historically in the United States, where people own more equities either directly or through their 401ks, which could then impact consumer spending and eventually impact GDP, but especially consumer spending in the United States, I think particularly. Now, if you've seen the number of steps that I've gone through, there's an if in every one of them, and then there's a holding everything else equal in every one of them. And so take that with a grain of salt. But I think the immediate impact is exactly what Aubrey said on the volatility. And I think for us, we've always said that our strategy does better in more volatile markets. We weren't really sure that that's true. But this year, when we did have higher volatility, it really did kick in and show that it does actually work. And so the lessons from how this strategy performed in the fund since inception, but even in my old fund, closed-end fund from 2003 to 2011, whenever you have higher volatility, our type of strategy works better, or at least works best relative to other periods in time. And then when we have cash like we do now, this is where we can actually add value as active managers. I really don't think, not just us, any active manager can add much value in a world with low volatility. I want to take a question from the floor. Richard?
Thank you. One of the notable early slides, was a comparison of the P of the market, I think, to the free cash flow yield of your portfolio. Taking out Microsoft and Alphabet, which you have done, and which have slightly different characteristics in terms of free cash flow to the others because of stock-based compensation and their notable low capital expenditure, one would have thought that spending a lot of capital in heavier business models would be a good thing. If you have a high return on capital and you're retaining cash and spending it, one might think that actually, if anything, a low free cash flow yield would result. Obviously, the missing number in that is the valuation, but could you comment on why you think the free cash flow yield is so different in your portfolio from the PE, and secondly, why that's a good thing rather than a bad thing?
Okay. Aubrey? Okay, so, I mean, the number that we have here is essentially just a gap number. And so, which is not the number we use when doing valuation. There are things like stock-based compensation that when looking purely on a free cash flow yield basis, you have to adjust for, because technically it's real, but economically I would argue that it's not. I think in the case of Microsoft, if we're talking specifically about Microsoft and Alphabet, we're talking about two different things that are going. There is a common theme between them in that they're both spending on data centers. And that is very capital intensive. But in that segment of their spending, while the returns now are decent, I think the returns on a long-term basis are going to be really good. And the reason we think that is the case is that you now are in a period of hyper-growth for data centers. And when you're in that phase of growth, you're spending way, way ahead of growth, and you're earning way more on the side of overspending. And so if your capacity utilization in your fleet essentially is at X%, say 70%, but you're growing at 20, 30, 50, in Microsoft's case, 100% in terms of cloud loads, then you cannot afford to be wrong and underspend and then fail your customers. And so what they will do, and what they have been doing, is basically pushing ahead years and years in terms of predicted growth, which means that their average capacity utilization on these assets is actually relatively lower. But then they're catching up within a year because of the fast pace of growth. We expect that as growth moderates at some point in the future, because we've seen this phenomena in other industries. I mean, most classically in retail, for example, when you're opening stores very quickly, as essentially your fleet matures and as your top line growth rate comes down, you have better capacity utilization. You'll be better able to plan that CapEx and be essentially more efficient in your spending. Whereas now they have to spend as much as they can to keep up with the growth. Long term, we still think, even now the returns are fairly good, but long term I think the returns are going to be really, really amazing. And one reason that's the case, which is the second part that relates to Microsoft specifically, is that you've transitioned your sales from a license or one-off transactional basis to a service, software as a service basis, which has been a tough transition for most companies in the software industry. But then you've now built all these services around it. And as you do that, you end up essentially tying in the customer. I don't like, nobody's there forcefully, but essentially the stickiness of the revenue increases over time. And it becomes smoother and more predictable. And you can do that while at the same time being able to deploy a lot more capital than you historically can in a software business. And so now you have a lower volatility top line, a lower volatility margin, and you can deploy a lot of capital in that business at good to great returns on capital. I think you end up with a much more economically valuable business at the end of that. The transition is still very early in its days. The software as a service has gone the most, but the other services like cloud-based services, getting people from on-site to hybrid to fully on the cloud, and everything else that they're doing around that in terms of moving computing power essentially to Microsoft from their on-site. I think there's a very long runway there. And I think at the end of it, those businesses are worth a lot more. The reason we sold them is we think that they got to prices right now, or sold a big chunk of it, where the risk reward has changed. We don't think they're necessarily overpriced by a huge margin, but we're always thinking risk reward. And that dynamic has changed, in our opinion, with the recent run in those stocks. Did I answer the question? Charlie? Sorry, over here.
I think, the thing is, well, there's Aesop's fable, one bird in the hand is worth two in the bush. So if there is an opportunity to get cash now, sometimes that is better. But, look at companies that we own like Merlin. That is a company that is redeploying cash and has fantastic opportunities to do so. We will invest in companies which have a lower optical free cash flow yield, but only when we are confident and do not have to make too many assumptions about the future and about their reinvestment potential. The trouble with a low free cash flow company that is reinvesting is you do have to keep making assumptions about their ability to reinvest. And obviously when we can do that, that's great. But when we can't, we'd rather the bird in the hand.
I think it's very rare that you find a company that's reasonably priced that can generate. There are a lot of companies that generate higher returns on existing capital, but there are not many companies that can generate higher returns on incremental capital that are high. But more importantly, and even rarer, it's capital that's being deployed in the same business, in the same fashion as the existing stock of capital, versus going and buying another company or getting into a new line of business. So from a risk point of view, that situation is you have an incremental return on capital that's usually higher than the existing returns on capital, while risks are lower on that incremental dollar that you're putting into CapEx, because you're putting into a business that you know that's already been there, which I think leads to much higher valuation on every dollar that you invest. And if you can deploy significant amount of capital into that over a 10-year period, and you basically replace like 2/3 of your capital base at that point, and you have much better business, and if you can see that, if you can get clarity on that, which is rare, then it usually ends up being a really, really fabulous investment. Our approach is that we want to see if we can adjust to a scenario where there is no growth, but also try to figure out, like we talked earlier about the maturity of the fleet. If you do have a maturity of the fleet, if you stop growing, what you end up with is not the current free cash flow yield. If you stop growing, for most companies, you end up with a much higher free cash flow yield because your assets mature. And the question is, at that point in time, in that scenario, how much is the business worth? And we think that puts a floor under the valuation, which is how we think about Merlin especially. But in the case of these two companies, I think it got slightly above, and we found other opportunities this year, which led us to essentially move capital from them to the other opportunities. Sophie?
Sure. Okay. How do you decide whether to buy a certain stock?
We only buy stocks that go up. No, I think we, let's see if we can go back. We have it here. So essentially what we're looking for is three things. One is we want to buy great businesses. And we define great businesses as companies that have great customer economics, that they have consistent top line and margins, they have higher returns on capital, they have good to excellent cash conversion. And then the last one, which is very rare and we don't always find it, is the ability to redeploy capital incrementally at higher returns of capital. And we want to expose ourselves to these businesses by buying the securities, usually equities, of great companies, which we define as companies with management that is on our side, has a capital structure that's conservative without too much debt, and a management that has a history of doing good capital allocation. Because there's no point, most of the cash that those businesses end up generating will remain with the company. And as minority owners of these companies, if management takes the cash that's generated by the fabulous business and ends up redeploying it into a shitty business, then yes, we've generated the money, but then lost it immediately thereafter. And once we find these businesses and these companies, then we can think about the issue of valuation. And most of the time, they're not cheap. A lot of the time, they're not even fairly priced. And so we have to wait and follow them for months, years sometimes, until something happens that does not fundamentally change our opinion of them, but causes the stock price to go below what we think is a conservative value of those companies. So that's what we look for. But the actual way we go about it is what we call the process. And that starts, the first part is what we call killing the idea quickly. And that is an efficient way of saving time, or at least that's how it started, by saying no quickly. But then we discovered over time that getting yourself in a position where you start by looking by what's wrong and ugly puts you in a much better frame of mind to avoid confirmation bias. The fact that you're looking at a company or a stock already means that you're positively biased to start with. Otherwise, you wouldn't be looking. And so trying to find the red flags, which we start with, the first part we do is the quantitative ones, which are a very quick and easy way of saying no. And then the qualitative ones where we're looking for something that's qualitatively wrong. And if we can't kill the idea, then we dig deeper into what we call the deep dive. But at that point, we hope that at least we have overcome some of the positive bias that we went into the idea with. And at the very least, we started thinking about what's wrong. And that's always a good thing to have. In the deep dive, again, we're trying to answer the question, is this a great business and is this a great company? And if it is, then the last thing is trying to say how much do we think it's worth. Like I said, it's often not cheap at that point in time, which means we add it to a wish list, continuously follow it, continuously update the value that we think is fair, and at some point in time, hope that one of the companies on that list gets cheap and we can buy it. So that's the long answer, I guess, for that question. From the floor?
Thanks, Sophie. Aziz, just backing off of what you just talked about in terms of the kind of companies you look to buy, can you walk us through Nordstrom and what you find fundamentally attractive about their business, given all the disruption that's taken place in retail?
Yeah. Nordstrom is a company that we have owned off and on, essentially, for 12 years. We've owned, this is one of the highest percentage position sizes that we've had, other than 2009, when we bought a lot of it. And we've had it to almost zero. Obviously, the company has changed a lot over time. But the thing that attracted my attention to it 10 or 11 years ago, when we first started buying it, is that it was a few years after the young Nordstrom cousins took over management. And they came out and they said, listen, we have our name on the door, and we want to preserve this business not for the next 5 years or 10 years, but we want to preserve it for decades. And we think that a lot is changing in retail. And this is all obvious now, but they were talking about this more than 10 years ago. And they said, what we're going to do is the following. We know that if we do not become an online leader in our business, we will die. And we also know that many of our competitors will not be willing to do what we are willing to do, because a lot of the necessary investments are going to flow through the income statement as opposed to the capex statement, which is usually historically what retailers used to do, because a lot of it is IT and fulfillment and hiring and things like that. But we don't care. We're going to spend the money, and it means that we're going to earn less money every single year than we would have for the next 10 years. But if we don't do it, we're going to die. And they were right. And they have spent enormous amounts of money building what I think is, if not the top, then certainly one of the top fashion retailers in North America. Their market share in online is an order of magnitude bigger than their market share offline. They have the biggest online business of anyone in their industry, and they're growing faster than anyone else. And they continue to invest, so we can think they continue to under-earn because of that. And more recently, when we increased our position in it a couple of years ago, we looked at it and the carnage that was the US retail industry, which to some degree continues to be the trend. And we looked at their brick and mortar business, and we looked at their online business. And Nordstrom very early on did something very smart, which people are just now catching on to, which is they did not have a separate online division in terms of management. What they did is that they split the business by full line and discount. And the reason they did that is that they argued, I think correctly, that from the point of view of the customer, customers don't care that they bought from Zara.com or Zara, the physical store. But Zara and others still to this day have silos between the two, which is why if you buy something online, you want to return it to a store, it's a nightmare. If you buy it from a store, you want to ship it back, it's a nightmare. They have separate warehouses, it's a total mess. That's how the rest of the industry did. What Nordstrom did very early on is they said, no, we're going to treat each one as a business. We don't want people in full line to be fighting whether the credit and the income gets booked in this division or this division. We're all in one boat. Let's run it that way. Let's make life easier for the customer, and we'll deal with the accounting and the background. It doesn't matter. It meant that very quickly, the numbers that they were reporting for online, offline were essentially meaningless because there was a lot of buying in store, return online, and vice versa, and all of that. But that doesn't matter. What matters is that from the customer's point of view, they have been able to reach more customers and make higher average selling prices and volume off of every customer that they reach in a period where everybody in retail was just suffering. And that type of long-term thinking, which they were able to do because they did have the family as an anchor investor, is what we look for. We want companies that are thinking 10, 20, 30, 40 years down the road, not companies that are thinking next year. And I think that attracted us a lot in terms of capital allocation. The size of the position now is a function of valuation. When we increased it 2 years ago and again this year, it was because we thought that the brick and mortar alone, if you chop it off and sell it, they won't. But if you did, is worth more than the price at that point in time. If you looked at the online alone, if you, again, chopped it off, it would be bad for the business. But if you did, it's worth a lot more. The discount business was worth almost the price of the stock. It was just, there's so many ways where this will not lose us money. And they had massive optionality on the upside. They continue to, and we think they continue to under-earn, and they continue to push the envelope in terms of experimentation and how they change the customer experience. So some of the things they've been doing recently, which again, other companies don't want to do it because it hurts the stock price when they announce it. But things like Nordstrom Local, where they went and they built these boutiques everywhere, where you can go order something online, they'll ship it to a store that's not near you, but down the street from you. And you can go try things on, keep what you want, and send it back. When things like, not click and collect, but actually click, send it to the I don't know, the Bellevue changing room in the men's area, and they tell you, go to changing room number 3, by the door. What time do you want? 3 p.m.? Go at 3 p.m. You're going to find the clothes hanging in there. Try them. Keep what you want. Leave the rest. All these things that they're changing and investing and experimenting with, really, in terms of pushing the boundaries of what it means to be a retailer tomorrow, I think are very important. Most of their competitors continue to think online, offline, and they think about what it means to them, not to the customer. From the floor.
Is it a pre-M&A play?
Is it an M&A play?
Yeah.
Well, the family tried to take it private. When was that? A year ago, I think. June of 2017, I think. And then they delayed it. They tried to actually make a bid, and they did eventually make a bid earlier this calendar year. The board did not accept their bid. We did not like the idea of them going private since the beginning because we thought the stock was just ridiculously cheap. It's not as cheap as it was, but it's still undervalued. The family doesn't own enough of the business that they can do whatever they want, which is always a good thing. So you want a controlling shareholder, an anchor shareholder, not a controlling shareholder in most cases. But they were basically, they couldn't raise the financing to take their, I think, 30% stake to 100% stake. If they couldn't raise the money last year, I suspect they're not going to be able to do it in the future. Now, can they partner with someone else? That is possible. We hope that they do it a few years later just so we can get some of that return before they do.
How worried are you about market levels and trade wars?
I mean, yes and no. I'm always worried about everything. Ever since I was a kid, I'm always finding things that could go wrong. Turns out to be a very valuable skill for an investor. It's shit for life. Sorry. But it makes you a good investor, I think. There are many things that could go wrong. I mean, our sale of Expeditors specifically a few months ago was because of that. And while we always talk about not making macro bets or making decisions based on macro bets, when we find ourselves in a situation where there is a potential macro event that could severely hurt a company that we own, that is not priced into a stock, then that's an obvious sell, and vice versa. I think sometimes that's an opportunity to buy. So I worry about trade wars specifically because I have very low confidence in the team that's managing the process. I don't think they're intelligent. I don't think they know what they're doing. And I don't think they understand the ramifications of getting it wrong. And that worries me a lot. Now, how does that translate into portfolio decision is a different matter. In some cases, again, with a 5 to 10 year view, which is how we make decisions, a lot of these things don't matter, but some do, like the case of Expeditors. Another way to essentially also build that into our thesis for the ideas is to expect higher volatility in markets, which means that we need to think about that when we are building a position or exiting a position. It also means we have to think about that when we're thinking about cash in the portfolio. And so it does feed to some of the portfolio decisions, even if it rarely feeds into individual security positions, unless it's a very obvious thing, like the case of Expeditors. From the floor? All right, I'll take more from Sophie.
how is Aziz personally allocating his capital right now? And another related question, how does Aziz manage his personal portfolio?
Okay. This is not financial advice. Just for the sake of the record. I mean, purely from a financial point of view, what I do is nuts. What I do is I have essentially all of my liquid net worth in the fund. I have a little bit of cash outside, and I have a couple of illiquid assets, but basically everything else that I own that's liquid is in the fund. That goes against every financial theory and everything that any financial advisor will tell you to do, and I agree. The reason I do it has absolutely nothing to do. I don't do it from the point of view. I'm basically betting on the fund. I'm betting on equities, which is also how I generate my personal income. There are so many reasons why this is wrong from a financial advisory point of view. The reason I do it is that I think it makes me a better investor. So I do it because I think I have to eat my own cooking, and I also think that it makes me think about risk really hard. Knowing that I have so much to lose. But don't do it yourself. Any more questions from the floor? Okay.
Similar to how you described your investment process and the different steps, could you please describe the quarterly review process and how you decide to either dial up or dial down a position?
So every quarter, after companies report, Aubrey and I sit for a couple of days and try to think first of every assumption that we have built into our valuation models with what happened recently in terms of reporting. Are there any surprises that came out of the reports that make our thesis wrong or seem to be wrong? So we go through every single company that way. And once we're comfortable that our assumptions have not materially changed, if they have materially changed, we call it a broken thesis, and we usually just sell the position because we were obviously wrong about it, and we should sell, cool down, and then reapproach if we think we suddenly have new insights. But if we were that off, it means we didn't know what we were doing going into it. Often it's some tweaks here and there that we do, and then we do that for every company, and then we try to again do essentially an upside. I mean, I think I have something here. But when we do a valuation, we run simulations. And so, let's see if we have one here. Here. So what we do is we run simulations. Sorry, this is really tiny, but we run 10,000 simulations based on the ranges of assumptions for sales growth, margins, debt, all the fundamental moving parts of the model, and try to, instead of thinking about a base case, bull case, and bear case, we want to end up with a distribution of cases. And we try to think about the shape of that distribution and where we are in terms of price relative to that distribution. And the reason we do that is purely that we try to think in a more probabilistic fashion than a deterministic fashion. So instead of thinking, oh, if this is my base case, which introduces a whole host of biases itself, having a range of potential outcomes, which I used to do with 3 or 5 cases, then we took it to a simulation, puts you in a frame of mind where you're thinking more about the fat tails and whether you're okay with the fat tails as the outcome of the assumptions that you put in. Once we do that, we try to then look at every position in terms of a risk-reward basis, and we look at the total portfolio. We do essentially a Markowitz optimization inspired model portfolio based on risk reward, where if it's a higher return relative to risk, it gets a bigger weight and vice versa. We don't actually use that portfolio directly and copy it, but we use it as a guide to think about whether we have very big positions in things that the outcome of our process says are not attractive investments. So there is a manual override on top of that. There's a lot of back and forth and a lot of burritos and chips usually. But in the end, we end up with a portfolio changes based on that process. Okay.
Can you share a case study or two of some proprietary research you have done that has led to investment decisions?
Yeah, I think the case of Nordstrom is basically one of that, and we went through the exact same process to arrive at it. So maybe let's take one more from the list.
Sure. What is your global economic outlook?
A lot of macro questions. I mean, we don't. I don't know. The reality is we don't have outlooks. We don't think we can think about outlooks. The reason we don't do that is that in order for a macroeconomic outlook to matter, enough for you to make a decision based on it, two conditions need to be met. One is, well, three conditions. One is you have to be right. So if you're wrong about it, then you lose money. The other thing is you have to be right and you have to be different from the consensus. If you have the same view as everybody else, then again, you can't make money on that. And then the third thing, which is often the most problematic, it needs to be an actionable insight. So if you have a view on global trade and you own, again, expediters, which makes money essentially by facilitating trade, then that's easy. That's one of the rare cases where it's very easy, where this is a business that makes more money if global trade goes up, makes less money if global trade goes down. That's very, very rare. In most cases, there is no direct link. And trying to make a big picture decision on the portfolio level based on that, while some people claim to know how to do it, I don't think we know how to do it, and so we don't attempt to. Instead, what we do is we look at underlying economic exposures by looking at the underlying portfolio revenue streams and try to think about things over a much longer period of time. And if we do have a view that is informative in that sense, in regard to how they impact revenue, then it usually will be a view that is specific to a position and not a portfolio, an overall portfolio view. So it'll be more like being wrong on Swatch in what happened to their China sales 3 years ago, where it's very obvious that you've got a business that 40% of their revenue comes from one country. If you think there is something that's happening in that country that's going to impact revenue, it's a very obvious decision level decision. Or some of the work that we've done on Evertech, where Puerto Rico has had its problems, continues to have some problems, but there is a very clear link. Most of the time there isn't that clear link, and most of the time it doesn't matter over a 5 to 10 year period that you do have a view.
Your overview on what Tesla is trying to do.
Aubrey?
I used to be a huge Tesla fanboy. Not of the stock. I used to really want one of those cars. And used to admire Elon Musk hugely. Actually, I still do. He's a crazy billionaire. He sold his first computer game for $500 to some computer magazine, age 12. And then obviously he's had countless successes since. But yeah, he does seem to have lost the plot a little bit. The accusations to the British diver. Okay. I think he's just bitten off much more than he can chew. And actually, we were discussing this the other day about what happens when price exceeds valuation by so much. Because we were just saying, actually, Tesla could have been a really nice little business. It could have been another Aston Martin, maybe even another Ferrari. It was a luxury product. People love the Model S. But you cannot justify the market cap of the Model S alone. So he had to do more. And it just seems that he always has to do more and more and more to justify the valuation. And I think this is, not the valuation, the price. And I think this is a problem when things do get too overvalued, that managers then think they have to do something to justify the price and not actually control the market. Actually, you should look at Constellation Software. Mark Leonard, he had a fascinating letter where he said he used to not worry about his stock price, but he then realized that actually he really did need to worry about it and needed to keep it within some degree of fair range. Because if it got too cheap, you'd have barbarians at the gates. If it got too expensive, his core shareholders would leave and be replaced by fast money. But I guess this is just another case of why valuation does matter.
Yeah, I think this is a fascinating case because we usually, and it's a very long discussion, but this type of kind of feedback loop usually matters more to venture capitalists. And some of the venture capitalists in the room probably have more insight on that. But as you attract more and more capital from investors, classic web van type of problem, if you remember that, you have to continuously increase the size of this total addressable market to justify the capital that you've raised. And at some point, you cannot say, well, we have a profitable business here, let's just stick with it, because the gap between that and the capital that you've raised if you're private or the stock market cap if you're public gets so big that your over promises essentially have caught up with you, and you need to continuously, it's like someone on heroin where they're just getting deeper and deeper and deeper into that, and at some point they just reach the point where they cannot promise more because there cannot be more, and then at some point they cannot deliver what they promised, and I think the whole thing comes down. I have a specific problem with Tesla, but especially with Elon Musk, which is why I think he needs to go to jail. And the reason I think that's the case is I think Silicon Valley specifically, but culture in general, has come to think of these superstar CEOs since Steve Jobs as having a license to do whatever they want. They can misbehave with their employees. They can be terrible to their team members. They can be terrible to women. They can be terrible to society. They can do whatever they want. And now they can even break securities law and nobody is going to do anything to them. And I think we have to stop this. Just because they're brilliant in either inventing or building a business, that does not give them the right, in my opinion, to not live by the same rules of society that we all have to live by. And I think if we don't stop it, this is an extreme case of it. If we do not stop it, if we do not make a point out of Elon Musk, unfortunately, in the US, the environment may not be the best one for that, but if we do not make him the poster child for the end of this insanity, I think we're just going to see more and more cases of that. Even by people, in Silicon Valley now, there are people who will advise you as an entrepreneur on how to behave badly if you're a genius, because that is what everybody expects of you. So this has gone in a very bad direction. I think Mario there had a question. Sorry, Max.
So you run quite a concentrated portfolio. You have, what, 20, 30 names or so? And that goes from very large companies to mid-caps and presumably some smaller companies. What is the percentage of your names where you have a direct relationship with the management, and how do you feel about the necessity or otherwise to have that?
Yeah, so we basically don't talk to management. I used to years ago, and stopped many years ago. And this is not a prescription for every investor or every fund manager. I found over the years that most CEOs, especially, are good sales people. And they will sell you in whatever idea that they want to sell you. And they did not get there by being, some of them are uncharismatic, but usually they're charismatic, they're good salespeople, and they will positively bias you more times than not. And I found that on average, I've noticed whenever I've met a management team in the past, I got way more positively biased than I was otherwise. But more importantly, I got more overconfident about what I thought I knew. Having that direct connection made me think like I knew more than reality. And it was a very, very rare cases that I actually got anything of value from that interaction. And so I stopped talking to management. I stopped meeting management. We have a rule now that we can contact the company, but we do it with three conditions. One, we do it in writing. So we don't want to talk to them over the phone. We don't want to meet them. We ask specific questions. And we only do that after having done all the homework that we're comfortable doing and trying to find all the answers that we can prior to that. So we can then go and send them questions in writing saying, I don't know, what's the number of stores that you have, or something very specific. And we don't ask open-ended questions. So it's not for everyone. We probably lose some things on the upside because of that behavior, but I've found, at least for us, for me specifically, that it just introduces way too much unnecessary bias into the process.
Perhaps I could tell a quick story on that.
Sure.
I was, at my last firm, I was working actually not far from here, and there was a company that we were looking to short. Actually, I don't know if any of you have heard of Quindel. It's about $3 billion market cap. I knew for a fact this was a fraud. I mean, one of the worst frauds, and if you're talking about wanting to see someone in prison, Rob Terry should be locked up. It was an absolute Class A fraud. I knew it. We had him come in. First thing he does is he wall crosses us. So we're inside, we can't trade his stock. So that was 90% profit on a short that we couldn't make. But then the guy was good. I mean, really good. He was doing this whole Darren Brown mind trick thing. I could see it. And I came away out of that meeting thinking, no, maybe I'm wrong. Maybe we could buy it, or maybe just a 6-month trade. Or, hang on, what am I doing? I know this is a fraud. No, he was that good. So what am I going to benefit from meeting a manager? Well, if they tell me anything that's actually really interesting, I'm going to be inside. And if not, I'm risking, maybe not quite a Rob Terry, but if they're half as good, you're going to be biased in the wrong way. So just, not worth it for me.
Yeah, I think you can learn. I'm not saying managements, don't get me wrong, I'm not saying managements don't matter. They matter a lot. I mean, when we talked earlier about Nordstrom, a lot of it was basically management, especially 10 years ago, before we saw the results of what they said they're going to do. But I think we decided that we prefer to see it through their actions as opposed to their verbal interactions with us. Like I said, it's not for everyone. It's what we found works for us. The next question from you.
Yes. What does it mean to be rated 5 stars by Morningstar?
Finally, a good question. Philip, you want to take that?
Thank you. Actually, I was telling some of the gentlemen here that we did a comparative analysis for our 5-year anniversary letter. We took the Bloomberg and Morningstar constituents of our peer group and found ourselves in the 10%, the top decile of performance. But last year, in October, I believe, we were rated 5-star Morningstar rating on risk-adjusted basis. That means that we're in the top decile of our peer group. So this is the official sort of acknowledgement of the worth of our performance and risk. So it's a Sharpe ratio type of calculation, but instead of the risk-free rate, you take the average return the peer group has taken.
Yeah, I think, and a lot of, by the way, a lot of the work to make that happen, I have to credit Philip with it. I think he did a great job kind of chasing them and then getting us on their radar and then eventually getting the rating. And it's a lot of continuous work for him, or was at least until we're up and running. I mean, one of the things that you'll see in our profile soon is that we're going to end up getting some of the things like style risk and holdings are blanks now, but we decided that we're going to start sharing some of that information with them. So it'll start showing up on the website. We had a lot of soul searching there before making that step, but I think for the sake of transparency, it's the right thing to do at this stage. The thing with Morningstar specifically, the way they do it is they take a weighted average that is luckily more heavily weighted towards longer terms. So they look at your risk-adjusted performance over 1 year, over, is it 3, 5, and 10? Yeah. Yeah. And then they weigh the longer term better. So the longer your track record of outperformance, the more stable and meaningful that rating is. Past performance is not indicative of future performance. The reason I like Morningstar specific is that they do it on a risk-adjusted basis. So you all know we outperformed, but then at least they do it on volatility. That's not our preferred measure, but over 7 years, it's not far off because you're going to have some big drops, and this is how we think about risk, what happens when shit hits the fan. It definitely helps in terms of marketing, I won't lie. We're happy we have it. It doesn't change anything we do day to day, but it seems to make you as our investors happy, and it seems to attract the interest of more investors. So overall, I think it's a plus. Question from the floor? All right, we'll take one. Oh, a lot of people sent, 18 questions I think we got before.
We have a good few more. What is the latest action taken in the portfolio, and can you explain your reasoning behind it?
Yeah, again, we talked about this earlier, about the changes the past couple of months where we reduced our ownership in Alphabet, Microsoft, Visa, and MasterCard. Alphabet, we continually sell it. The reason it's no longer in the top 10, but the reason it was continued to be in the top 10 is that we sold it kept going up. Terrible problem to have. But yeah, I think we just think that on a risk-adjusted basis, the risk-reward was becoming less and less, or the reward to risk was becoming less and less attractive, which is why we sold down the positions. We did not sell out completely because we think valuation is still reasonable, and we still think that over a 5 to 10 year period, I think we're going to do well by holding them, but we don't want them, we no longer want them to be among our top 10.
Thanks. Do you look at any sort of turnaround or distressed type investments where the future may be materially different to the past? And I guess also for companies without that much history.
Yeah, I mean, the latter we don't. We usually don't invest in companies that don't have history. We're not that smart. Turnarounds are tricky. I don't know, I remember it's Buffett or Lynch, one of them said most turnarounds don't turn around. They're tricky, but we've made a lot of money in turnarounds over the years. I mean, but it's been when it wasn't really a turnaround. Often you see a situation that looks like a turnaround, but in reality, it's especially when you have multi-divisional type companies or companies in transition. It's just you need to do the homework to actually find the core that is there and that is going to continue to be there. If the future is going to be completely different from the past, I don't know how we can make any decision about what kind of cash flows and returns and margins the business of that future is going to look like. But often what ends up being the case, I mean, when we bought Microsoft, we were just talking about Microsoft, it was during that transition where their traditional software business was declining and software as a service was increasing. We continued to own a much smaller position in IBM, which is also in a turnaround in a sense. But in all of these cases, and many others in the past, there was a core that we thought was there, it's going to continue to be there. Financially, things were changing, but at the core, it was the same business. And when you find these, and they're rare most of the time, they are genuine turnarounds where something is fundamentally broken. You can make a lot of money in them. Higher risk, but you can make a lot of money in them if you buy them at the right price. I think the trick is to find something where there is something that's consistent between past and future.
Why are you secretive about your portfolio holdings and the reason for holding them?
I don't know. I don't like the word secretive. So, I mean, we do disclose the full positions every year when we send out our audited report, and we do the top 10 obviously every quarter. And now because we decided to share the top 10 with Morningstar, and we have a rule where everybody gets the exact same amount of information. We're going to also be adding the top 10 to our monthly tear sheet. So the positions will be disclosed unless we're actively buying something, which rarely happens in the top 10. Because usually if we're buying, it would be smaller. If we're actively buying something, then we may not disclose it or disclose it with a lag, basically. I mean, the reason I don't like to talk about what we're buying or selling is twofold. One is we're not there yet, but at some point, the knowledge of someone knowing that we're buying or selling something could impact the volumes of what we're buying and selling, and that could have an indirect impact or direct impact on basically the price and indirect impact on the long-term returns that our investors make. So it's in no one's interest to disclose things where you could invite some competition at that point in time, or you're actually building a position or exiting it. That's not the case when we're talking about a Microsoft or Alphabet, obviously, or a Johnson & Johnson, where the volume is so big that no matter how big we are, it's not going to matter. For some of the holdings, it does. The more important decision, we don't like to talk about specific holdings, is that I think it brings in a lot of bias. Once you go up in front of people and start defending a company, especially early on in the stage that you own it, you become wedded to the idea because you've gone out on the record and defended your decision. And it makes it harder for you to change your mind if, I don't know, a couple of months later or a week later, you discover a piece of information that completely shatters your thesis, and the right thing to do is to sell that position. And this is especially the case when you're talking to individuals. I'm very happy to talk about individual positions to other fund managers, for example, because I also don't feel like I owe them anything. If I'm talking to an individual, I feel like if I change my mind, I have to call them up and say, by the way, I changed my mind on XYZ. We thought it was a buy, now we don't think it's a buy. That's just not a good position to be in. But with a fund manager, then it's their job to figure it out and do their own homework. So if I change my mind, then I don't feel as much of a duty to call them up and say, by the way, I've changed my mind. So it's a lot of factors, and all of these are downsides, and I don't know what the upside is. So I've yet to find any upside to that unless someone asks a specific question, an investor asks a specific question. Then in that case, it's very obvious it's their right to know why we own something. But other than that, I don't see the upside of publicly talking about it.
What's your cash position? Why does it fluctuate so much? And is that reflective of your view on the market?
Okay, so cash today is at about somewhere between 16 and 17% of net assets, up from just under 10 in June. And actually, at some point, it was in the mid-single digits, or a bit lower even, during the year. And as I mentioned earlier, this time last year, we were at 18. So it went from 18 to those single digits, now back up. We never think about cash as an active decision. The way cash goes up or down is a byproduct of our process. So we talked earlier about portfolio review that we do every quarter. If we find that XYZ company that we own is too expensive and we need to sell it, then we sell it. And the act of selling it generates cash that goes into the cash position. And if we find another company that we like, we buy it, and that takes cash down. And so we don't think about cash at all unless there is an exception, and the exception is if cash is zero. And when cash is zero, you need to think about cash because we run an unlevered strategy. And so at that point, you think about cash. Well, you have to think about cash because it doesn't exist. So if you want to buy something and you don't have cash, then you kind of essentially do, you may still think something else is cheap, but you want to buy something that's cheaper or a better risk reward. But even in that case, arguably, you're still not thinking about cash because you're thinking about the rest of the portfolio and how you allocate between them. So yeah, it's essentially a byproduct. It doesn't say anything about, it's not an active decision. In theory, though, if we find a lot of ideas, meaning that markets are cheap or at least volatile, then our cash would go down. And so if our cash is low, it does literally mean we have better ideas in the portfolio or are able to find better ideas. And if cash continuously goes up, then it means we can't find ways to put it to work. And so that's the level of it. But we think cash is an option on future decisions. Having cash today means that you can buy something attractive tomorrow. Not having cash deprives you of that option. And you have to think about all of the investments that you're going to make on a essentially weighted average basis over the next 10 years. And if you happen to have cash year one, but then have a great investment that was not available in year one, that's available in year two, but has a great result at the end of the 10-year period, then you should hold cash today because it gives you that option to buy in year two. That's how we think about it.
What's the upper bound on cash flow? Is it 20%?
We don't have an upper bound. I mean, by mandate, we can theoretically go up to 100%. Given we run a 20 to 30 position type portfolio and invest globally, where the opportunity set is literally thousands and thousands of companies, I cannot see a situation where we can't find any ideas and everything is expensive, so we continuously sell until we end up with 100% cash. It's highly, highly unlikely that that is the case because you can always find something, I think, in a big enough universe. But that does not mean that in any week, day, or month, it cannot go higher than what we want. Ideally, we'd like to be fully invested in fairly to slightly cheaper companies and hold them while they continue to be the case and compound forever and then go to the beach. But that's not the world we live in. One more from you.
Sure. How is Mayar looking to position itself in case of an economic slowdown?
We do think that the portfolio decisions that we do at our quarterly review, which are being built from the ground up, essentially build in our implicit views on the economy. And so when we buy Procter & Gamble because it's reasonably priced on a risk-adjusted basis and don't buy something else, in a sense, we are running a more conservative portfolio than prior to buying it. And in the past, as valuations have crept higher, we've thought more about risk. We always think about risk-adjusted returns, but we focus more about that the later and later we are in a market or economic cycle. And the reason that's the case is that if we can buy a business that we have very high confidence that it's going to give us high single-digit returns, for example, at a time where we think the market is not going to do more than low single-digit returns probably, then that gives us a very decent return, but also gives us the optionality to sell them in a downturn when these types of businesses don't usually get damaged as much as other businesses and buy things that have gone down substantially. I mean, going into 2008, which is prior to this fund, but the portfolio I ran was almost fully invested. I think we went in with maybe 4% cash or something like that. But we'd ended up owning so many names that were more predictable, higher quality, lower debt type businesses that are fairly valued, at least. And when the market dropped, they did not drop as much. And then we sold them, and like I said, we bought a lot of businesses that just got killed, or a lot of stocks that got killed, and which is how we did well in 2008 and 2009. We always think 5 years out. So if there is a chance that something could happen where our portfolio goes down by 20% next week, but we are very confident that on an underlying basis, we're going to come out at a decent return over the next 5 years, we're not going to do anything. We say in our principles that we are long-term only, and that's what long-term only means. It means we will ignore the short term. That is what we say we will do, and it's what we do. And again, it's not for everyone, but I think it makes us positioned to do better decisions.
Okay. So we're approaching the end of the meeting. So we've got our final question.
Is there anyone
else?
From the floor? All right, let's do the final question then.
So what are the biggest challenges facing Mayar Capital over the next 5 to 10 years?
Okay. So again, we're talking about the firm now, and the firm has obviously changed a lot over the past 7 years. It used to be me sitting in an office that I sublet by myself in front of a Cap IQ monitor, reading all day. That was fun, actually, I won't lie. Well, now we have a team, we have a lot of support, and I think that makes us a better firm. We can service our partners better. We can, I think, do better decisions by specializing in the different tasks that are required to run an asset management business. The biggest changes, I think, in the short term is I don't see any changes in our core philosophy, but like we talked earlier, we are always trying to improve how we go about our process. I mean, one thing that we changed recently, I think we have here. So 10 years ago, I had a checklist that was paper-based, which became a nightmare fairly quickly. And then I think 3 years ago, we built it into Excel, which is this, where we have a checklist and we score every question, come up with aggregate scores. You see that this is Expeditors again, where we can, I think, take qualitative factors and turn them into quantitative factors that allow us to think about positions between what we own, between different positions, but also what we own versus what's in our wish list and what's out in the market. And then last year, we invested in building that, we call it a research process system. We called it Project Pronovost after Peter Pronovost, the guy who championed for the use of checklists in ERs in the US. We built this online. So we took our checklist from being Excel-based, we put it online where we have a database behind it, but also a very user-friendly interface that we can access from our laptops, we can access it from our iPads, and answer the questions, but also segregate the tasks. So I can take some of it, Aubrey can take some of it, and Inter can answer some of the questions, and then we build it into, and then aggregate it into the final outcome. So this is an evolution, not a revolution, and I think we continuously have to move in that direction. Some of the work, I mean, one fascinating thing that's happening now that we were just talking about yesterday is what's happening to computing power. Everybody talks just about AI, but actually even just computing power and how it's changing. I mean, think about how running a business today versus 10 years ago and the implications of having cloud, having someone provide you software as a service, and all of these things that did not exist just 10 years ago. A lot is also happening in terms of computing power and like everybody's talking about artificial intelligence and machine learning. And that will have an impact definitely on the asset management business, on investing. Is it going to revolutionize everything? I don't know. I don't think so. But I think you continuously have to evolve and use the tools that you have. If someone had a typewriter 30 years ago and then word processors came along and said, I refuse to change how I type, I'm going to continue to use my typewriter. Well, they're a lot more efficient with a word processor than a typewriter. And now that it's cloud-based, then it's, again, an evolution of continuous efficiency where, yeah, you can start typing something up on your desktop, leave your office, go home, continue working on the same document where you stopped on your iPad or do it on the phone. So I expect a lot of evolution in how we approach the research process specifically and how we continuously automate bits and pieces to allow us to focus more on the things that are more qualitative, where our input, our judgment is more important as opposed to our time. So the more we can automate time tasks and free up more time for judgment tasks, the better we will be as investors. And a lot of that, I think, is happening and continue to happen. And then the other thing is, as we grow, we continue to build the team. I mean, we've invested a lot the past year in operations, in onboarding and transitioning to a fully integrated portfolio management system and an order management system. So there's a lot of infrastructure type investments that we have to continue to do. And then we also have to continue to build the team as things evolve and as we grow. So some of you may have seen that we put out a job post. We're looking for an investor relations and marketing person. So that's an area where we're growing just because we've grown from a handful of investors to, I think now we're approaching 100 investors or so. And so we need help in making sure our investors are being taken care of properly and freeing up more of my time so I can focus more on the investing. So again, it's always an issue of how can we free up more valuable time by segregating responsibilities, by bringing in more talent, by diversifying, increasing diversity at the team level, where we can bring different opinions and different ways of approaching the task of investing.
Aziz, if we can squeeze in one last question, sorry. When will you pay out a dividend?
So I think this question was asked last year, and we said that we will create a dividend share class. We do not anticipate paying a dividend on the main share, the A or B share class, but we created a second share class, A1 and A2 and B2. And what those share classes do is that they do pay a dividend. Now, there is something different how we've structured them than a regular income fund. We will not pay out the underlying dividends of the portfolio holdings, especially because now we're talking about two dual share classes. But the board will declare a dividend for the specific share classes once a year. The board and I will talk about it and try to target roughly a 2% payout. And so essentially, if an investor chooses to move from the regular share class to the dividend share class, they're going to get roughly that 2%, average 2% over time. And that means that their capital gains are going to be 2% less than someone who is in the regular share class. Well, other than that, their total returns are be identical. They own the exact same portfolio. I don't think it makes sense, which is, there are tax reasons why people do it in income funds that don't apply to us. And given that they don't apply to us, it doesn't make sense to make the decisions of the payout, tie them directly to the underlying decisions of what we own. We have the liberty of segregating them, which is what we've done. And that hopefully does two things. A, frees up the investing process to focus on maximizing total returns, not payout. And then the other thing is provide our investors who do need immediate income with a relatively smoother payout that grows over time with the long-term trajectory of the net asset value of the shares. Okay. Right? Any more questions from the floor? Well, thank you all for coming so much. We really appreciate it. I really want to thank Sophie again for putting it all together, and everybody who made this happen inside the company, and all the help that we've got from Home House and all the wonderful people who've made this possible. I definitely could not have done it alone. Please, I think we still have some free food out there. We're value investors. We cannot pass on free stuff. I hope to see you in future annual meetings at some point, hopefully at a big stadium with queues that start at 5 a.m. But I appreciate you coming even when you don't have to queue for that. So thank you all.